To my friends in real estate business, I have bad news for you. If you're a real estate developer and your books still show income and expense, you're already behind. You're not just tracking rent checks and receipts. You're managing projects, building assets, and making long-term plays. Your books need to reflect that. Most developers only think about bookkeeping when cash gets tight and their CPA starts to ask questions. Or worse, when tax season is literally a week away. By then, it's already a mess. You open QuickBooks to figure out where the money went, and suddenly, nothing makes sense. If that sounds familiar, this video is for you. I'm going to show you how to set up your books inside QuickBooks Online for real estate development. You'll learn how to build out your chart of accounts, track project costs, and structure your balance sheet to show real assets, not just expenses. If you're serious about running your projects like a real business, let's get into it and keep watching. Why regular bookkeeping doesn't work for development projects? Well, most businesses track revenue and expenses to see how they're doing month to month. But real estate development works a little different. You are not selling services or products every week. You are investing large amounts of capital upfront, holding that investment for months, and only seeing revenue once the deal closes. Basically, it's a long game. That might be a sale, a lease, or a refinance. If you use standard bookkeeping, you will run into two major problems. This is where most developers get it wrong. They use basic bookkeeping systems that track cash in and out, but development projects need something else. You need to capitalize your costs so that your balance sheet reflects the value you are building. This gives you a clear view of what the project is worth. It helps you stay compliant, and it makes your financials make sense when your lender, investor, or CPA comes asking. The good news is you don't need new software. You just need to set up QuickBooks Online the right way. That means customizing your chart of accounts, tagging costs by project, and tracking the assets as it grows. When you do it right, you can see exactly what you're building, what it's costing, and how much equity you are creating. That's what real bookkeeping looks like for real estate development. How to set up your chart of accounts in QuickBooks Online. So before you track a single dollar, you need to set up your chart of accounts the right way. If you're a developer, your setup should be structured for how real estate projects actually work. Here are the basics you'll need. Assets for each property or project you are developing, liabilities for loans, lines of credit, or investor money, income, which is gain on a sale, expenses for overhead and general business costs not tied to a specific project. Inside the asset section, set up a parent account for all of your development projects, then create a sub-account for each individual project underneath that. Here's an example of what development project parent account looks like, and under it, Oak Street Townhomes, Riverside Apartments. Each of these project sub-accounts will hold all the costs tied to that specific property. And we are not done here. You should also create sub-accounts under each property to separate the land purchase from improvements made to the asset. For example, our Oak Street Townhomes would have Oak Street Townhomes land and Oak Street Townhomes improvements. That includes labor, materials, permits, engineering, and anything else you put into that project. You might be thinking, why does this matter? Glad you asked. You don't want all your project costs getting dumped into one big category. That just creates noise. You want clear project level visibility. You want to see which jobs are profitable and which ones are bleeding cash. Set it up clean from the start, and everything else becomes easier to manage. You will know exactly how much you spend on each project and how to price the property for sale correctly. Another advantage of this breakdown is for when you sell the property and need to move it off the balance sheet into hopefully gain on a sale. Now, how to track project costs properly. Here's the rule. If a cost directly contributes to building or improving a property, it belongs on the balance sheet. It's part of the asset. You should not treat it as an expense. Large purchase, that's an asset. Architect fees, asset. Construction draws, asset. Permit fees, also an asset. Inside QuickBooks Online, you can track these costs in one of the two ways. First is use journal entries if you're comfortable with manual accounting, or the easier route, use bill and check entries that map directly to your asset accounts. Here's how it works. Say you pay $25,000 to your general contractor for foundation work on Oak Street. Instead of coding that payment to an expense account, you code it to your asset account, Oak Street Homes, under the costs. Now, that $25,000 shows up on your balance sheet as part of that work in progress asset. In improvements, it doesn't show up as a loss on your profit and loss report. When you do this consistently, QuickBooks QuickBooks gives you a real-time picture of how your project is building, not just how much you spent, but where the money is going. And when it comes time to apply for financing, bring on investors, or file your taxes, you already have clean records that back everything up. That's how you track costs properly when you're building real assets. The only downside of this type of tracking is not having the details when it comes to job costing as the project is moving along. So when our clients would like to have that detailed picture, we do set up a regular profit and loss job costing, but we make sure to journal entry those expenses to the balance sheet before sale or filing taxes for the year, or if financial institutions are requesting documentation. I do not recommend using this without supervision of an expert help, like your trusted accountants and bookkeepers. These journal entries need to be very carefully crafted using customized reporting. Another way to solve this problem is to use project management software to go into more detail on each project, but be careful connecting it to QuickBooks Online because the mapping would need to be adjusted accordingly. How to capitalize interest, insurance, and other indirect costs. Let's be clear here, not every overhead cost should go on your balance sheet, but some absolutely should. And if you skip them, you are underreporting your true cost to build. Here's the rule. If the cost is directly tied to building a specific asset or project, capitalize it. If it's general business overhead like office rent, admin, salaries, and software, expense it. Example of capitalized cost is interest on a construction loan used to finance the build, builder's risk insurance that specifically covers that project, utilities directly related to construction phase. In QuickBooks Online, you can handle these by either posting the cost directly in the project's asset account or using a recurrent journal entry for costs like interest or insurance. This is where a lot of developers fall short. They leave out carrying costs and end up with books that undervalue the project, and that means fewer deductions and a lower reported basis when it comes time to sell or refinance. When you do it right, your books reflect the full cost of the build. That's your actual basis. It matters for taxes, it matters for lending, and it matters for your long-term profit. When to move from work in progress to a fixed asset or cost of goods sold. One of the most important bookkeeping steps come when a project is complete. That is your signal to reclassify your costs out of work in progress. Here's how it works. If you are selling the property like a flip or spec build, move the cost from work in progress to cost of goods sold once the sale closes. This shows your project profit on the P&L. If you're keeping the property like turning it into a rental, move work in progress into a fixed asset account like building and begin depreciating it. Don't use gain on sales for spec bills. That's reserved for selling long-term capital assets, not inventory. If you are holding the property, reclassify work in progress to a fixed asset. That could be buildings, that could be land improvements, or furniture and fixtures, depending on the type of the project. Let's say you spend $3 million building a 10-unit rental. Once it's placed in service, you move those costs into a new fixed asset account. That's when depreciation begins. In QuickBooks Online, you'll use a journal entry. You would debit rental property, buildings, the fixed asset, and credit Oak Street townhomes, which is work in progress asset. You're not changing the amount of money, just where it leaves on the balance sheet. You're updating the books to reflect the project's new status. Now your balance sheet shows an income producing asset and you are ready to start depreciating it properly. How to handle investor funds and loans in your books. Most development projects involve outside money. That could be investor capital, loans, or both. And if you are using someone else's money, you need to track every dollar with clarity. Each source of capital should be recorded separately and accurately. Here's how that looks in QuickBooks Online. If the investor expects repayment, book their funds as a liability. If they have ownership in the deal, book it as an equity. Construction loans go into a liability account. When you draw funds, the loan balance increases. When money hits your bank account, record it like this: debit bank account, credit investor equity or loan payable. When you use that money for construction, post the spending against your work in progress asset account. That creates a clean trail from funding to use. You need that for audits, for investor updates, and for your own records. The goal is to keep everything clear and tied back to the original source. At any point, your books should be able to answer 3 questions. How much did we raise? How much have we spent? What's the return? If you can't answer those, your books are not giving you the full picture. Why this matters? Well, accurate project-based bookkeeping gives you real decision-making power. You can see which projects are profitable and which ones are falling behind. You can back up asset values when banks or investors ask for proof. You can justify draws, returns, and distributions without confusion. You reduce audit risk with clean records and a clean paper trail. You improve your ability to forecast cash and plan for what's next. And as an added bonus, when tax season comes around, you are not scrambling. Your CPA can pull your basis, depreciation schedules, and funding sources in just a few clicks. Bookkeeping is not a back office task. It's a core part of how you run and grow a development business. And yes, QuickBooks Online can handle all of this if you set it up right. So action steps to get started. If all of this feels like a lot, here's where to begin. Set up your chart of accounts by project, track every direct cost to those asset accounts, keep personal, business, and investor money in separate accounts, reclassify costs when a project is completed or sold, and of course, my best piece of advice, work with a bookkeeper or CPA who actually understands development work. Don't settle for vague numbers or messy reports. Clean books give you the clarity to scale and the confidence to lead. Closing real estate development is already very complicated, but it doesn't mean your books have to be. When you treat bookkeeping like an investment, you make sharper decisions, build trust with investors, and you protect your profit. If this video helped, hit like, subscribe, and let me know in the comments where you're stuck. I want to hear what you're working on and how I can help. Thanks for watching.